The hope is dead. Jerome Powell just walked up to the podium and essentially told every single person holding stocks, real estate, and crypto to prepare for impact. The pivot that the mainstream media has been promising you for 6 months is officially a fantasy. The Fed just slammed the door shut on rate cuts, and that sound you hear is the economy hitting a brick wall at 100 miles an hour. If you think the soft landing is still on the table, you are being led to the slaughter. We just entered the most dangerous phase of the financial cycle, where the Federal Reserve intentionally keeps the pressure on until something systemically important snaps. This isn't just a policy shift, it's a death sentence for the current bull market. Welcome back to John Explains Money. I'm John, and today we are breaking down the emergency shift in Fed policy that has effectively locked in a recession for 2026. This is the most important broadcast I have ever done because the trap is now set. The Fed is no longer your friend. They are the executioner of this debt-fueled bubble. Smash the like button right now so this reaches more people before the mainstream media spins this into something it isn't. Subscribe to John Explains Money because this is only getting worse, and you need to know exactly how to move your money before the exit doors get jammed. Turn on notifications because this story is moving fast, and the next 72 hours will determine who keeps their wealth and who loses everything. Let's look at exactly what just happened over the last 48 hours, because the timeline is a sequence of betrayals. Bloomberg reported that the internal consensus at the Fed has shifted from when to cut rates to if they should cut rates at all this year. The market was pricing in 3, 4, maybe even 5 rate cuts just a few months ago. Today, CME data shows those odds have plummeted to almost zero. Jerome Powell's recent language wasn't just hawkish, it was a declaration of war on asset prices. He explicitly stated that the last mile of inflation is proving to be a nightmare, and that the Fed is prepared to keep rates at these restrictive levels for as long as it takes. Watch what happens next. Because when the Fed keeps rates higher for longer into a weakening economy, they aren't trying to fix inflation, they are trying to break the back of the labor market. WSJ noted that while the headline employment numbers look strong, the underlying data is rotting. Full-time jobs are disappearing, part-time jobs are exploding, and the average American is now working 2 or 3 gigs just to pay for eggs and gasoline. The Fed knows this. They see the same data I do, but they are staying the course. Why? Because the system needs a reset? This part is the real bombshell. Most people think the Fed is waiting for inflation to hit 2%. They aren't. They are waiting for the reverse repo facility to hit 0 and for the liquidity to be completely vacuumed out of the banking system. If you think I'm exaggerating, wait until you see this. Data suggests that we are currently in the longest yield curve inversion in the history of the United States. Every single time, 100% of the time, that the yield curve stays inverted for this long, a massive recession follows. The Fed is essentially keeping the economy in a chokehold until it stops breathing. This is worse than people realize, way worse, because the interest on our national debt has now surpassed our defense spending. We are paying over $1.1 trillion a year just in interest. The government cannot afford these rates. The banks cannot afford these rates, and you certainly cannot afford these rates. Analysts have warned that as the Bank Term Funding Program expires and the Fed refuses to cut, we are looking at a liquidity desert where credit simply stops flowing. This is how you get a 2008-style freeze, but without the ability for the government to bail everyone out without causing hyperinflation. Now, let's talk about who is behind this and who profits. Because in a crisis, wealth isn't destroyed. It's just transferred. This looks engineered. The timing is incredibly suspicious. By promising rate cuts all winter, the Fed lured retail investors back into the stock market at all-time highs. They let the Magnificent Seven pump to astronomical levels, while the smart money was quietly moving to the exits. Someone clearly benefited from this fake-out pivot. The big money center banks, the ones that are too big to fail, they are sitting on record cash piles. They want these high rates. Why? Because it kills their competition. It kills the regional banks. It kills the independent mortgage lenders. Someone knew this was coming. They knew the Fed would slam the door shut, and they are prepared to buy the wreckage for pennies on the dollar when the defaults start. Most people are missing this, but the real story isn't silver. It's the banks. In 60 seconds, I'll show you the real trigger that turns this Fed pause into a total market meltdown. But first, we have to look at the domino effect that is already starting. Domino 1, the bond market. As the Fed slams the door on cuts, bond yields are spiking. The 10-year Treasury is screaming back toward 4.5 and 5%. When yields go up, bond prices go down. This means every pension fund, every insurance company, and every bank holding these bonds is seeing their balance sheet bleed out in real time. Domino 2, the stock market. Stocks are priced based on the discount rate. When you realize the Fed isn't cutting, the math for a P/E ratio of 30 no longer works. We're looking at a massive revaluation of the entire S&P 500. If yields stay here, the stock market has to drop 30% just to be fairly valued. Domino 3, real estate. Mortgage rates are already ticking back up toward 8%. The housing market is a frozen wasteland. Buyers can't afford the payments, and sellers are trapped in their 3% loans. This is the great lock-in, and it ends with a wave of forced liquidations as unemployment starts to tick up. Domino 4, crypto. Bitcoin and the rest of the market thrive on excess liquidity. When the Fed slams the door, the liquidity vacuum starts. Crypto is the canary in the coal mine for liquidity. If the Fed doesn't cut, the speculative fever breaks, and we see a brutal deleveraging. Share this with someone holding BTC, stocks, or real estate because they need to understand that the Fed put is gone. Jerome Powell just took the safety net away, and the market hasn't realized it's falling yet. Pattern interrupt, macro zoom out. Look at the debt to GDP ratio. Look at the historical cycles of empire. Every time a nation reaches this level of debt, and the central bank tries to save the currency by crushing the economy, it leads to a structural reset. We are not just in a recession, we are in a regime change. The era of cheap money, the era that made you think you were a genius for buying an index fund, is over. We are moving into an era of capital scarcity. In this environment, cash is king, but only if that cash maintains its value. Hidden chart moment. If you look at the correlation between the Fed's last hike and the start of a recession, there's usually a lag of 12 to 18 months. We are right in the heart of that window. The Fed slammed the door on cuts because they are terrified of a second wave of inflation, like we saw in the 1970s. But in trying to avoid the 70s, they are walking us straight into 1929. KOT reports indicate that institutional short positions on the Russell 2000 are at record highs. They are betting on the small caps, the heart of the American economy, collapsing under the weight of these interest rates. What should retail investors watch next? This is your survival guide. First, watch the initial jobless claims. If that number breaks above 250,000 and stays there, the recession is no longer forecast. It's a reality. Second, watch the credit spreads. If the difference between corporate bonds and treasuries starts to widen, it means the credit heart of the economy is starting to fail. Third, watch the small business optimism index. Small businesses are the biggest employer in this country, and they are being absolutely decimated by these rates. Fourth, keep an eye on the reverse repo facility. When that hits zero, the emergency liquidity that has been propping up the market for a year is gone. That is the trapdoor moment. Turn on notifications because this story is moving fast. The Fed's next meeting and the minutes from the current one will be combed for any sign of a crack in their resolve. But don't expect them to save you. They have told you their plan. They are going to keep the door slammed until the house is empty. Now, let's look at 3 scenarios for how this plays out in 2026. Scenario 1, the slow grind. The Fed keeps rates here, the economy slowly bleeds, unemployment creeps up to 5 or 6%, and the stock market just sideways bleeds for 2 years. This is the lost years scenario. Odds? Low, because the system is too leveraged for a slow grind. Something always breaks first. Scenario 2, the credit freeze. A major regional bank or a commercial real estate fund defaults. The interbank lending market freezes because nobody trusts anyone else's balance sheet. The Fed is forced to do an emergency cut, but it's too late. The damage is done. The recession is deep and violent. Odds? High. Scenario 3, the inflationary pivot. The government forces the Fed to cut rates to fund the deficit, even though inflation is still 4 or 5%. The stock market pumps in nominal terms, but the value of the dollar collapses. You make money in your 401k, but your 401k buys half as much as it did a year ago. This is the Argentina scenario. Which scenario do you think we are in? Let me know in the comments below. I want to see if you are seeing the same engineered signs that I am. Comment crash if you are already moving to a defensive position. Actionable takeaway. 1. Cash is your weapon, but not just any cash. High-yield money market funds or short-term T-bills are where the smart money is hiding while they wait for the slammed door to break the market. 2. Eliminate all variable rate debt. If you have a credit card balance or a HELOC, pay it off or fix the rate now. The Fed is telling you that high rates are the new normal. Don't let them bleed you dry on interest. 3. Look for value over growth. Companies that actually make a profit and have no debt will survive this. The zombie companies that rely on cheap debt to stay alive will go to zero. 4. Diversify into hard assets. Silver, gold, and Bitcoin are the only things that exist outside of the Fed's door. If the system freezes, you want something that doesn't rely on a bank's permission to move. The world is waking up to a financial trap. We were promised a pivot. We were promised a return to normal, but the Fed just showed us that normal is dead. We are in a high-stakes game of chicken between the central bank and a mountain of debt. The Fed just threw their steering wheel out the window. They are not turning. They are not cutting. They are staying on this path until the crash occurs. Smash the like button so this reaches more people who are currently being lied to by their financial advisors who tell them to just buy the dip. There is no dip to buy when the liquidity is being drained. There is only the abyss. Subscribe to John Explains Money because we are going to be tracking the Fed's every move, the shadow banking stress, and the real-time data that the mainstream media is too compromised to report. This part is the real bombshell. Did you know that the Fed is actually losing billions of dollars a month right now? Because they are paying more in interest to banks than they are earning on their own bond portfolio. The Federal Reserve itself is technically insolvent. The lender of last resort is broke. They are keeping rates high to try and suck capital into the U.S. to support the dollar, but in doing so, they are killing the very economy they are supposed to protect. If you think I'm exaggerating, wait until you see this. Data suggests that consumer defaults on auto loans and credit cards are already at 2008 levels in some demographics. The consumer is broken, the bank is stressed, and the Fed just slammed the door on the only thing that could have saved them. Recession isn't just likely, it is a mathematical certainty. Watch what happens next, because the uninversion of the yield curve is about to happen. Most people think when the curve uninverts, the danger is over. They are wrong. Historically, the actual crash happens when the curve uninverts. That is when the recession starts. That is when the layoffs go from a trickle to a flood. We are months, maybe weeks away from that signal. Stay vigilant, stay liquid, and stay tuned. The John Explains Money community is about surviving the reset and thriving on the other side. Don't let the slammed door hit you on the way down. This is not financial advice. I'm not a financial advisor. This script is for entertainment and educational purposes only. Always do your own research and consult with a professional before making any financial decisions. The Fed policy is a complex and high-risk environment. You are responsible for your own capital. I'm John. This is John Explains Money, and the recession is locked in. The only question is, are you ready? Because the door is shut, the lights are flickering, and the soft landing just turned into a free fall. See you in the next one. One last thing. Share this video with someone who still thinks the stock market can only go up. They need the wake-up call before their retirement account becomes the next casualty of Jerome Powell's war on inflation. Smash the like, comment crash, and get your house in order. The end game is here.